Well, greetings, investors. Welcome to the July 2023 Investing Roundtable. We have dubbed this the Bridge to Investing Better. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and a volunteer for the Better Investing Mid-Michigan chapter. I am joined here by a number of, I consider them to be phenomenal friends first and great investors also. They've put together some nice commentary for you here tonight and perhaps some nudging and ideas. Starting with on the left at the bridge up there, by the way, that's the Mackinac Bridge. For those of you not familiar, that's between the two Michigan peninsulas, and it's a pretty spectacular view up in the northern part of the southern peninsula. Joining us tonight, we have Kim Butcher, and Kim is splitting time between Evansville, Indiana, and Florida. I believe you're in Florida now, Kim. Is that correct?
I am in Fort Lauderdale. Yes, I am.
Well, good deal. So it's cranking along and taking care of business. Second from the left, that investing raconteur, award-winning Ken Kavula. Welcome, Ken, and good evening.
Good evening, Mark. Thanks for being here. We appreciate it. And good evening to all the folks from mid-Michigan and throughout the country. We're glad to have you with us, especially glad to have an audience on a hot, steamy July evening.
And we have to hope that the Michigan weather cooperates and that we don't lose electricity or anything else along the way. Third in line, we have Cy Lynch from Atlanta. Good evening, Mr. Lynch.
Good evening, Mark and everybody. I'm trying to wave, but it's not coming through on the picture for some reason. So glad to be here.
So are the Atlanta Braves out of town, or are you just giving them the night off, or?
They're out of town in Boston in a rain delay at the moment.
Okay. So. Well, that explains why you're here. Good to have you. And speaking of raconteurs, he gets around quite a bit, and he's joining us here tonight. Welcome back, Hugh. Are you?
Thank you.
Are you in California?
I am. Yeah, it's very hot here as well. 100 degrees, not humid, but hot. A little bit warmer than we're used to.
Well, it's good to hear your voice. Glad you're back, and hopefully we haven't misbehaved too much in your absence. But welcome back.
Thanks.
All right, Portillo's is not the part of any presentation tonight, but it did sneak onto the cover slide. They are not sponsoring this presentation, but they should be. Okay. And not all of those companies on the right are going to be in presentation. There's a couple that we're just nudging away, but you will hear about PayPal, Visa, and Truist. And that should have an Atlanta Braves flag flying next to it also. But our mission here tonight is to simply share some ideas with you and have some fun along the way. All right, so let's go ahead and get underway we're trying to keep the introduction down a little bit, so bear with us, everybody. Here's the standard disclaimer. No investment recommendation is intended. This is completely about education, demonstration, illustration. What we are literally attempting to do is take about 8 decades of wonderful experience, the legacy of experiences of success that many of us have either witnessed or experienced personally with the modern investment club movement. So we're trying to look at the methods to discover stocks, to analyze stocks, and basically build a tracking portfolio. I find it fascinating that we have actually built quite a track record with a very wide range of approaches, and they're all consistent. We're looking for better companies at better prices, but it's just a lot of fun to have a group of friends put together portfolios which have performed so well. That said, they are our opinions. Please do your own homework and thorough analysis of any company before making your own investment decision. If we happen to own something, we will try to remember to disclose that. If you'd like to be added to a reminder about this event, a mailing list, please send an email to nkavula1@comcast.net. Again, we hold these sessions always webcasts and generally on the last Thursday the last Tuesday of every month at 8:30 Eastern Time.
Mark, we're getting a number of emails from people that are changing their email address and would like Natalie to change where she sends the reminder, and they're having a hard time figuring out how to do that on the website. If you drop Natalie a note and says that you are changing your email address, she will in turn send you back a Word document that she's created, which gives you step-by-step instructions about how to change that email address right on the Better Investing website. So it's a pretty easy process, but it's not as intuitive as it might be. So if you've been trying to do that and can't seem to get it done, send Natalie the email. She'll send you that Word document, and then you should have very clear step-by-step instructions.
Okay, let's go ahead and get underway. Again, just as a reminder, we've been doing this monthly since July 2010, and really it is just to share ideas. We're coming with an idea. We do basically stick predominantly to core, blue chip stalwart positions, but we do entertain some fairly lively speculative or non-core investments also. Our goal is simple. We would like to beat the Wilshire 5000 by 5 percentage points, as shown there on the left, and we'd like to see about half or a little bit more than half of our selections actually outperform the market also. The graph on the right is basically a look at how well we have done. It's basically the answer to the question, how much are you beating the market by? And the math is right up there at the top. The rate of return for the positions in the tracking portfolio for 13 years is 15.4%. Over that same time frame, if you'd simply invested into the Wilshire 5000 index, that is tracked along at 11.1. So that's a relative return of 4.3, just one number minus the other. So beating the market by 4.3%. We'd like it to be 5. That is our objective. We have been above 5 quite a bit of the time here lately over the last several years, but it has dipped down below a little bit. That number at 4.3 would outperform a vast majority of public published portfolios. So it would actually be a very top tier performance if you got to looking at that. Outperformance.
Mark,
go ahead, sir.
Mark, we do have a hand in the air from Dave Roberts. Dave, I'm going to unmute you. Dave, you'll have to unmute yourself if you want to speak to us. You have a little microphone next to your name in the control panel, and if you click that, right now you're muted. And we're going to assume this is an inadvertent hand then, because Dave is not unmuting. So I'm going to put the hand down. And Dave, feel free to put something in the text box if that really was a legitimate hand in the air, and we'll get your question asked just as soon as we possibly can. Go on, Mark.
Okay, so that is the results here today. We'd like to see again, back above the dotted red line, which is the long-term 5% objective, and hopefully we'll get there soon. Lately we have had a little bit of sluggishness in the regional banks. We have quite a few in the portfolio, and our Delix has come back from $5 to $3.50, so it has kind of kicked things a little bit. Fortunately, we have some Google and Microsoft that has actually helped. Here's a look at the tracking portfolio. It is just the top 20. It's the top 20 by virtue of the size of the positions in the tracking portfolio. Let me see if I can't underline this. If you want to see all of the positions in the portfolio, simply go to that URL, and you can actually look at all the individual pieces. But the way you look at this chart, again, these are the top 20 positions by percent of total assets. And if a company is chosen more than once, that is what is shown in this ledger up here. So for example, Microsoft has been chosen 5 times. It shows up right here. So 5 times for Microsoft. Every time we make a selection, a decision, whether it's one of the knights, a damsel, or a guest, or the audience poll, we invest $1,000 into that company. So $5,000 invested into Microsoft is now worth $87,000. So that's a lot of good, clean fun. So from top to bottom of that chart, you can see that many of these positions are doing quite well. One of the oldest positions we pointed out almost every month is Costco. Hugh selected that 13 years ago. So a single position at $1,000 is now worth about 12. So whenever he's here, we remember to thank you, Hugh. Anything you'd like to add to here, Ken?
No, nothing except that we've noticed a couple of different times in the last 13 years that when the market takes off and does a little bit better than average, or as it's been doing the last 4 or 5 weeks, quite a bit better than average, the top of our list has to scramble to maintain our percentages because the par values actually move down when stocks are doing quite well. That's not very intuitive for some folks unless you really do a little bit of thinking about it. But remember, PAR stands for potential annualized return going forward. And if your stock is doing quite well, then it eats into that anticipated return, and that lowers the percentage for the next 4 or 5 years then as the stock continues to do quite well. So I'm really pretty confident that as the market goes back to having some normal ups and downs, that we'll move back to our +5 rating without too much trouble.
And I think we probably should point out that since the Braves are not on tonight, or at least they're in a rain delay, that many of these positions, Cognizant, various other ones, EPAM, Maximus, Cy likes his information technology stocks, and they certainly have been strong contributors over the years as he's stuck with them through thick and thin. So thank you, Cy.
You're very welcome. Patience pays.
All right. Anything else here? I think Kim says she's back. She actually was locked up, but she is back, so she's ready.
Yeah, I have it all. I've stayed up with her, Mark, so we're all set.
Okay. So with that, let's go ahead and turn it loose to Cy and the Atlanta Braves.
All right. Good evening, everyone. As you can see, tonight's pick is Truist Financial, TFC ticker symbol. I presented this a couple of years ago, and you'll, of course, definitely get around to the Braves connection later on in the presentation. You can see the value line has a pretty good potential return for it, from a low of 20 to high of 31%. And for a bank, you can see relatively consistent history. Of course, a little bit of a hiccup in 2020 when a few things happened in the world. And that big jump that you see in both pre-tax profit and sales, that was the merger between SunTrust Bank and the North Carolina bank that formed Truist Financial. So that's what accounts for that. Next slide. I took a look and found Truist by just looking at the portfolio, ranked by par, took skimmed down the left-hand column of company names that, companies that I follow or at least know reasonably well. Both Teletech and First Foundation have some of their own issues going on right now, and I didn't really feel appropriate to bring them. Truist Financial, though, I thought was a good opportunity in the banking industry, and you'll see why I settled on it as we go through. See, again, decent potential return according to manifest consensus. Next slide. Just a quick summary of Truist, the company. Management says they're in a sweet spot. They're the 6th largest U.S. bank. They have several national businesses, and they're also more hands-on consumer and small business-oriented businesses are more regional in nature. So they're a good mix between a larger national bank and a regional bank, but they're not a money center bank. Next slide. This is just a slide I've mainly put so you can skim it quickly or get a little bit better idea about how Truist introduces themselves as a company. This is from virtually all of their investor presentations on the website. I won't read it to you, but they seek to, as you can see, inspire and build better lives and communities, and looking at all of their stakeholders, if you will, clients, teammates, and of course other stakeholders. Next slide. Here is a little bit more detailed graphic that depicts some of what I'd said in the summary, where they are in a sweet spot. You see where they rank among banks in the United States. They're in between U.S. Bank and PNC Bank. And what they see is the advantages to the size and the both the size as in large, but also the smaller size. And then down in the left-hand corner, you see the breakout of the businesses, how they have corporate and investment banking and insurance on a national scale. And then the darker purple states are the more regional retail and small business banking and wealth management that you see. Next slide. One thing that I thought was interesting about the latest annual meeting report from Truist is that they really accented their efforts to empower their teammates, their employees. They raised minimum wage to $22 a share, and then you see employee stock purchase plans, stock ownership plans, as well as other initiatives they've taken to improve their relationship with their team members. Next slide. Here is some graphs that show how the business of the company is not overly concentrated. They're spread pretty diversely. You see in the first circle the revenues by lines of business, a good chunk being retail and small business banks, and they have commercial lending, wealth management, corporate investment, consumer finance, insurance, and then CRE is commercial real estate and mortgage, which is primarily residential there in the two smallest chunks. Then you see their non-interest income, insurance again being a significant portion. And notice that they don't have a huge amount in mortgage processing or mortgage fees, which is a good thing in this current environment. Then you can see the loan portfolio, primarily, or about half of their loan portfolio is commercial and industrial. And then you can see again the commercial real estate, the residential real estate, and other sorts of loans that they issue. A good mix of business, not overly concentrated in any one area. Next slide.
Hey, Si, I have an editorial comment. Can I throw one in before we go to the next slide?
Sure.
Since I'm running the steering wheel, I guess I can do that. I just want
yeah.
I don't know how unusual it is. If you look at the non-interest income, look at the contribution from insurance, 35% versus only 12% when it comes to the revenue mix. I'm not sure how much, all the banks in general sell insurance. Do they sell more insurance than the average bank that would be similar to them? Do you have any feel for that?
I believe they do. I did not really pick up on that in reviewing for this session, but my recollection is, yes, they do have a quite large insurance business. larger than most other banks. That is a distinctive. I do pick up. That's real interesting how, though, that you note that it's, 12%, 1/9 or so of the income, but a significant part of the non-interest income, so profitability. And I did, in looking at this, and I kind of mentioned it, at least alluded to, unlike many banks, their non-interest income is not tied up in mortgage fees or checking fees.
Yep.
You can see it's in quite a bit other sorts of things.
Okay.
So.
I just thought that was kind of fascinating. I think it puts some, it's a little differentiator.
Yes. And I believe that's from the BB&T half, the North Carolina half of the merger. I believe it's where most of that came from, not the wealth management came from the SunTrust side. All right. Again, you can just see here how they compare with their peers. I think that purple line in the second set of graphs, the one that's marked 20%, I'm guessing that really should be the one next to it, because I'm guessing that purple means TFC to distinguish it from the others. You notice TFC is purple on the left side, but they've got high deposits that are insured or collateralized compared to their peers. And you may be asking, why is that important? If you know the West Coast regional bank problems, you know why that's important, because uninsured deposits were a large chunk of the business for the West Coast banks that got into trouble or failed. And so the higher your deposits are, either insured or otherwise collateralized, the less likely that you may run into a problem with depositors trying to pull their money out because they're afraid of losing it. And then you can just, again, see some of the breakouts of their business categories. But what's particularly appealing to me in that bottom chart is the next to last line, really, which is weighted average relationship length. You see that their banking relationships are in double digits, really, most of them pushing near 20 years. So they have a very loyal, sticky client base. Next slide. I'm trying to think the main, again, there's a good bit of information in this slide showing deposits. The most important thing I just wanted to point out here, and it really plays more into the next slide, is you could see from the second quarter of 2022 through the second quarter of 2023, the dots at the bottom, that's their cost of funds. That's what they're paying on their interest-bearing accounts. And of course, in a rising interest rate environment, it's been going up. So that's a cost factor. Next slide. But what's important is, how can the bank manage those higher costs and translate it into higher interest income? The difference between net interest income and interest expense is called net interest margin, which are the dots and the triangles in this chart, which is the same time period. And you can see that for the first 3 quarters, Truist actually was able to increase their net interest margin even as their costs of funds were going up. You can see that it is slipping, which again is not unusual in a rising interest rate environment for a bank. But the reason I wanted to show both of the charts besides the visual was, if you compare the numbers and you look at the basis point, that is the actual decimal changes, you'll see that the basis point increase in net interest cost is lower than the decrease in net interest margin. In other words, they are successfully managing their margin and able to shift into higher interest rate loans. Again, that was one of the major problems going on in the banks that failed, was they had short-term money coming in, long-term loans going out, and they could not match the interest rates. Next slide. And this is just the summary slide at the end of their investment presentations saying why you should invest in Truist. And again, I'll let you take a look closer at that on your own time. But really kind of the major thing for me that I think fits here is that exceptional company. Much of what we've talked about here being a top 10, actually number 6 bank with strong banking footprint. Next slide. And then the last thing that I just wanted to point out about Truist is return on assets for a bank. This is an important metric, and above 1.0 is very good. And you can see Truist has been pretty consistently above that and is now, although they have experienced in the last couple of years, and it is a challenge for them right now, some increase in their interest costs, their cost of funds, and management is seeking to manage that and deal with it. Next slide. And here's your Braves connection. As Mark's already pointed out, I'm here with you all tonight, not at Truist Park, which is the home of the Braves. Next slide.
Is that picture taken from your seat?
That's just about. Here's my projections, relatively slow growth, leading to a $6 projection 5 years out from now, a little below both value line and the manifest consensus. Next slide. And then using an average PE of, and I'm just looking, I made the same mistake I do sometimes, about once a quarter I make this mistake. That average PE should actually be 11. 6 is the low PE. So it should be 16 for the high PE, 11 times for the for the average PE rather than the 6 there. And you can see high potential return of almost 27% using the high PE, or 19 using the low, which is essentially right in line with the manifest consensus. So I'm adding another 1,000 to Truist, hoping that it's a good luck charm for the Braves tonight in Boston, and hope that you'll join me in voting for Truist and the Braves.
All right. Thank you, Si. All right. Kim still believes PayPal is quite a value, and many of you agree with her. What's the latest on PayPal, Kim? She's back with us. You have to unmute, I think, probably. Uh-oh, Ken, did we lose her?
While we're waiting for Kim, we do have a question for Si. Si, could you tell us whether you own a position in Truist?
At the current time, I do not. Thank you for the question. I should have mentioned that, because I do like it and have owned it, and am looking at buying it but I'm not a current owner of Truist.
Thank you. Kim is with us in the back room, Mark, and she appears to be unmuted, but Kim, we're not hearing anything from you.
Okay, maybe we skip to the next person and give her some time.
And we can double back on Kim. Kim, if necessary, maybe you can call in, okay?
So next person would be you. And by the way, in addition to Western Alliance, I do have some shares of Truist.
Okay. This is Visa, and I own Visa myself, and I own it in 3 of the 4 clubs that I belong to as well. I presented it at the June 2023 roundtable last month, and I don't see anything wrong with it yet, so I'm going to present it again at the July roundtable. Next slide. I just want to get the word out that Visa is not a bank. Visa and MasterCard and the companies that process payments are not banks. They do not hold funds. They do not transfer funds. What they do is they transfer the paperwork and they allow the banks that sponsor them to handle the traditional banking duties. So you'll notice that your Visa card is sponsored by somebody many times, but it's backed by a bank. My Visa card, for example, happens to be backed by Chase Bank out of New York. Lots and lots of cards globally, lots of merchants globally. Visa is the largest company of its kind in the world. Next slide. This is the current value line. Notice it's dated May. We're going to get a new value line June, July, August, first week in August, and maybe value line will have changed some of its numbers, but they certainly liked this company. And I don't normally print the entire analysis, but this was a particularly glowing assessment of what Visa had done and where it was going. Note value lines projections, revenue growth at about 11.5%, earnings growth at about 13.5%. Let's see how that plays into my SSG. Next slide. This is the exact same picture that I showed you last month. Same judgments, growth at 11 for sales and 12% at earnings. Those dots that are being on the graph right there, those open dots, those represent Morningstar opinions as to where growth should be. The dotted line, which is going through the open dots on the sales line and is a little bit underneath the open dots on the earnings line, that's the 11 and 12 that I've put onto the SSG itself. So we're trying to collect all the data and kind of make it talk to each other and work with each other. This is exactly what I evaluated Visa at a month ago. Next slide. Thank you. Nothing not to like. The debt to capital number, why it shows red, for my mind, is amazingly consistent at somewhere between low 30s and high 30s. So I didn't particularly worry about it being red right there. Pre-tax profit on sales did dip a little bit, but not to any great degree to make it different from anything other than it's been in the last 8 or 10 years. So I'm basically pretty happy with the management comparisons. The stock closed at 226.30. And that means that that was in June, 226.30. And I was using PEs of 33 and 25, average PE of 29. I didn't change those at all. I kept the same numbers that I used a month ago in June. Next slide, Mark. In the June roundtable, the price I said was 226.30. Most recently, Monday's close was 240.74. That's a gain of $14 on a $225 stock. Pretty decent gain in 1 month. The upside downside went from about 5 to 1 down to about 3.5 to 1. I still think Visa is an extremely attractive stock, especially when you consider the size of this very, very, very large company. A growth number that exceeds the 7% that you might expect out of a large company is certainly impressive. And the par values that go with Visa, they're impressive as well. Next slide, Mark. Here's the SSG results summary. The one on the left is from June. The one on the right is from Monday night in July here. And I don't see much not to like. Par has gone from just under 12 to about 10.5. That still is exceptional par for this very large companies. Meanwhile, manifest numbers have gone from about 12.5 to about 11. So I do think that my SSG is being validated by another source. If you're looking for a financial stock that doesn't have some of the things that you have to worry about that are happening with some of the banks right now, you might consider Visa. And it's a great industry study when you put Visa up against some of the other credit card companies. And I might suggest MasterCard, American Express, Discover. They all have interesting SSGs. A great industry study, and I think Visa comes out as the cream of the crop when you do that. That's my opinion. You do your own homework. I think that's my last slide, Mark. It is.
All right,
Yep.
we can check and see if Kim is ready to go. She is asking if her audio is not working. She'll need a phone number, Ken. Let's see if she's
Okay.
Kim, are you there?
I just gave her the one I called in on. I texted to her
Okay.
just now.
Thank you,
but-
Sai. Thank you.
Kim, are you with us yet then?
She's not on our list right now unless she's on the, let me check the list from the participants. There she is.
Okay.
There she is. Hold on a second. Okay, Kim, you want to say something so we can see if your connection's working?
Ouch.
It came in green. Kim, can you say something to us? Still not working. Okay, I'm not showing a phone call yet, so you might have to call.
I guess I can go ahead with my segment and we come back to
Okay.
Kim.
Yeah, let's do that, Mark. Go ahead.
Okay.
All right.
All right, I'll try not to misbehave too much. All right. Well, I went through a couple of, let me make sure I've got the right one here. I went through a couple of things just looking and sniffing around for something worthy of taking a closer look. One of the things I wanted to take a look at was I went to the portfolio using that URL that we shared earlier in the presentation. And in this case, I sorted them from the opposite side. I'm looking for companies that were originally invested with $1,000 that have basically fallen off a little bit. And you can see Boston Beer heads the list. I still think Boston Beer is an interesting study. They are still shaking out the problems that they had with their seltzer drinks, and it'll be fascinating to watch. It's kind of a stubborn problem that they have. MarineMax, Intel, whatever. But looking over on the right-hand side, you can see the quality and the projected returns. I'm really looking for a solid combination of the two. Dollar General did kind of jump off the page a little bit with its excellent quality and its projected annual return, right there in the sweet spot. So that one is kind of tempting, but I decided to just keep looking just in case I might find something else. This afternoon at our bull session, Ken and I actually dug up another set of candidates, and I thought I would share when we released the Roundtable Hounds, what they came up with. And that is the results of an ivory soap screen that I've done for a number of years. If you go to the Manifest Investing screening criteria, I'm using just one input. I'm entering that 99.44% pure for ivory soap, and the Manifest rank is simply the combination of these two characteristics, the quality of the company and the return forecast. We blend them, basically equally weight them pretty much, and I'm looking for the top 0.5%, and that is what is on display here. Some fascinating companies. Ken pointed out this afternoon that MP Materials, a couple others on here, Gentherm, Malibu Boats, those are in our best small companies for 2023, so we are cheering them to the finish line at Halloween. So we know a lot about those companies. There's a number of decent studies on here. Ingevity has been recently brought to the round table as part of that electrification phenomenon that's going on. Taiwan Semi has also been added to the round table in recent months, and just kind of looking on top to bottom. This is not a lobby for votes for Psy, but Truist makes the list also, this top 0.5%. But the one that kind of grabbed my attention a little bit, because it's kind of been all over the map in the last few years, is Albemarle. That's the chemical company. Here's a quick look at the company. They're involved in the production of lithium. Lithium accounts for anywhere from 50 to 75% of their business. Lithium got red hot with some of the electric vehicle stuff that went on here over the last couple of years. And in fact, the stock price shot up in 20 and 2021. You can see that down here. That resulted in a downdraft in the return forecast. Maybe got a little bit ahead of itself. Yeah. Okay, do we have Kim back then?
I think you do.
Okay, so we'll be ready to go here in a second. I'll wrap up here in a minute or so. All right, so Albemarle is basically now trading at a multi-year high. You can see the quality rating up here at the top. Interesting company. They have gone through a little bit of a restructuring, and they're acquiring lithium resources. They've got stuff all over the world. 10% growth, 25% margins, PE of 17-ish. Again, we're looking at a company with 20% returns. That is validated by the projected return on value in that same ballpark. So again, volatile, but kind of interesting. Here you can see that the transformation of the company, whatever they're doing, they've added a little bit of margin, both operating and bottom line net margin. So the company has changed. The question is, do they stay there, or do they return back to the levels seen over the last 10 years or so? I don't know the answer to the question. I know that opinions are divided, because I look at Morningstar and I see a company that they think is very much on sale. The broader analyst consensus seems to agree with them, but you come up here to Value Line and they staunchly disagree. So you have a dissenting opinion there. In fact, it was dissenting enough that I kind of disregarded it and left it off the charts over here. So interesting. So I really couldn't get my arms around it quite as much as I normally like to. The price of lithium has been all over the map, again, with that rapid surge in lithium demand. And this is real, folks. I mean, lithium demand is projected to go up exponentially here in the next few years as the electrification of transportation and many other things actually takes place. So you can see the numbers here in this report by McKinsey, very comprehensive. I also like this chart, which says that there's a lot of things being impacted. The point that they made in this presentation, though, was that this battery industry thing might actually be underestimated in terms of what might be required. It's not just the vehicles, it's the stuff that goes along with the renewables and everything else, and perhaps some zoning and neighborhood type subsystems. So there's a lot going on here. Batteries are going to be needed. The question is, will it be lithium or something else? So when I got done making a perfect case for all this, pointing out that the price does go through these periods where it's kind of in a trading range for extended periods, and then it's had some pretty good experiences, as you see here and over here on the far right. Are we in one of those right now? Could be. And again, making the case, and then Ken decided to rain on my parade. He points out that maybe it's not going to be lithium, maybe it's going to be zinc, and this chitin. I had not heard of chitin, or if I learned it back in high school biology or whatever I took in college many years ago. This is basically the University of Maryland is working with people to develop a battery which contains not crab meat, but lobster and crab shell, and in addition to zinc. And it's got some very interesting properties in terms of being able to be recharged more times, holding a charge, and less likely to catch on fire or explode. So kind of an interesting situation. The point being, as you're studying this company, you always have to be thinking about, the innovation that's going along with this entire demand cycle and price, and what is the vulnerability of lithium being superseded by something else. Just got to kind of crank through it and wonder what actually might be the case. So Ken kind of talked me out of it. So with that, I'm basically just going to call an all-around audible. This is a chart we've been using for some time just to make the strong point that when we find a good company, like a Visa or one of size, Cognizant Technology, or Google's on this chart. In fact, Google had was up 8% after the market closed tonight. So they're actually going to be moving up this chart as soon as tomorrow. So these companies actually rank very powerfully in the long-term performance chart. Here's the round table right down the center of this chart. Again, that is super performance with respect to and relative to other investments, and a lot of good clean fun. Down here in Indexville, I refer to this as Indexville. Again, nothing wrong with a good 10 or 11% return over the long term. But the thing that we are noticing is the fact that the mid caps and small caps are actually down here underperforming here in the last few years, when normally they're at the top of this list of 6. And Sean Mace actually coined the phrase for the small caps and some of the mid caps, little rascals. We needed something to distinguish. And Ken, we were thinking of you. We wanted to give you an out here, because we have the red rabbit for our best small companies that we feature every Halloween. But in this case, we're talking about the entire Russell 2000. And that includes some companies that are not the best growth companies. There are some distressed merchandise and high undervalued opportunities. So they're in there too. So we're going to differentiate from the red rabbits and refer to these as the little rascals. And yes, he knew about your infatuation with Darla, Ken. So what we're looking at here and noticing is that we have a situation with the Russell 2000 where the projected return, we're going to emphasize that a little bit more than the par, is actually above average, and it has underperformed in the last few years. Again, the growth rate confirms the quality is okay. So we have a situation where that could be the case. So here's a derivative of the Russell 2000, just to make the point that in the past, when it's gone through periods, and if I could show you 2008, 2009, that was explosive back here. You had an explosive recovery from the COVID up to here. And again, Peter Lynch points out in his book, One Up on Wall Street, and his various teachings, that this is one of the reasons that we want small and medium companies in our portfolios, because coming out of a recession, and again, how much have you heard about the recession over the last couple of years that hasn't ever actually happened? Or if it has happened, it's been rotating and just kind of shifting. So when those days come to an end, and I think they probably will at some point, the small and medium companies do have the potential to do this sort of thing. I don't know how much and I don't know when, but I look at this chart and I see these Russell 2000 stocks basically down in near those COVID levels, below the blue line, and just kind of calling out to me. So I'm going to actually call an audible and invest in the Russell 2000 instead of an individual stock. Okay. So that's where we'll throw my 1,000 for tonight. So Kim, I think you're back with us.
Kim, you'll have to unmute yourself now. There we
I
go.
believe I am here.
And we
Can you
can
hear
hear
me?
you just fine, Kim. Go on.
Okay. I presented PayPal last month and it was a price of $66.23. Today it closed at $73.09. That was a gain of 10%. I really believe that this stock has got more room to run. I grabbed this last night off of Manifest, and it has a par of 15.9%. Next slide. PayPal was a spinoff from eBay. That's why I've had this company. I currently own it in my portfolio, full disclosure. They are a payment processor. Some people don't want to use Visa. They don't want to use their MasterCard or Discover card. They use PayPal because they think it might be safer. They've got a lot of worldwide transactions, and their total payment volume was 354 million, and it grew at 10% and 12 on a neutral basis there. But you can read this yourself. They came in with free cash flow of over $1 billion in the last quarter. As Ken said, I think it's August the 5th is when PayPal will be reporting out, and I double checked this morning and no, there's not a new value line in. So next slide, Mark. This is the PayPal value line, and Mark, with that red pen of yours, can you circle a few things for me?
Sure.
I remember when I had gone to the first Buffett meeting, one of those things I had read was that Buffett used to just look at value lines and flip them, and he would find a stock just by looking at the value line. So I'm going to have Mark circle a few things that I like to look at real closely, which really gets me excited. Number one is look at the ... in the graph of the picture. See how the black solid dot is below that? Circle that, because that's telling you ultimately, when you go over to the projections box of 2026 to 2028 on the left-hand side, they believe that the stock could have an annual return of 22 to 36% per year. When I look at a value line and I'm looking to find a stock, I won't touch anything unless it has a minimum of an annual return of 10%. That's a Kim preference right there. Looking at the picture and seeing that the stock price is below where the stock price is projected to go makes me think this stock is majorly undervalued. The trailing PE had been 35.4. Now it's down to 31. I look at a lot of different things on here, but these are the two big ones visually, which I look at it and says, oh, this makes me look really interested in this. Next slide. When I look at this, I have a tendency to just kind of go down everything real quickly. If you can see how revenues are going up, we go from right now in 2023 to $26.95, and it's going all the way out to $31.70. Yeah. Cash flow per share, earnings are always good, but cash pays the bills. So I like to make sure that they've got a lot of cash falling to the bottom line. And when you have $1 billion a quarter that's getting dropped to the bottom line, I'm pretty damn happy. They don't pay any dividends. A company can grow when they have all that extra cash. They can buy another company and do another acquisition, make more product. They can pay down their debt, which they are doing currently. They could buy back their shares, which they are also doing. That'd be one of the things that I will specifically look at when the next quarterly report comes out. I'll see how many shares did they buy back, and did they look like they reduce the share count, and did they go into treasury stock, or did they just disappear altogether? If you see where in 2021 they had no meaningful data because we were in the COVID situation, 2022 it was 46.8, but as the PE drops to 35, that usually means our price goes up. That's a good thing, because I'm suggesting the price will go up. Their operating margin is going from 23.5 to 27. That's really good. Look at these, all of these metrics, they're bouncing back from COVID, and their profits going up big time. Their tax rate's the same. Their net profit margin is going up. At COVID, it was 8.8. They think it's going to be out to 18.8. I'm a numbers girl. I like looking at what this is. Return on shareholder equity. I want to make sure I've got good capital allocation by my management team, and that is going out to 23%. I'm never going to complain at that. Next slide. So I think what's going on with PayPal is a catalyst event, and that's an activist that's involved, and it's Elliott Investment Management. And this has been in the news. They've been involved for a while. since PayPal is a digital payment, they had some losses because essentially management had done a couple acquisitions which really didn't turn out well at all. So they kind of are telling management that they need to do better capital allocation. With Elliott owning over 2 billion shares, they get a seat on the board and they kind of can guide the stock where they think it will be doing better. And the payments, they're cutting their staff and closing offices, and that's a lot of the tech companies are doing that because everyone's trying to get very lean and mean. Next slide. But where you really always like to ask yourself when an activist gets involved, are they good for the company? And in this case, I can tell you if Elliott management is involved, my favorite thing I say at these presentations is, folks, listen here. This is a cha-ching moment. They are usually always successful in making us money. Next slide. What has Elliott done? Well, the CEO has announced his retirement. They really feel he's done some poor capital management of buying some acquisitions, which really did not turn out well at all. They've gotten a new CFO in there, and they've announced a $15 billion repurchase program in their shares. They're probably going to sell off a couple of things that they bought, and it really haven't worked out. So that's what the activist is planning on doing. I think the activist is going to get the stock price to move forward. Next slide. This I got from the Morningstar report. I sent it to Mark, and he'll post it on the website tomorrow. And this was posted as of July the 24th. They thought PayPal's fair value was $135, and it had closed at $73.69. MasterCard had closed at $404, and it was at fair value of $389, so it really may be overvalued there. And Visa's fair value they thought was at $241, and last it was at $240. Now, this is not saying what Visa could do in the future of what Ken has presented, but it's saying, when I look at it, PayPal has a lot more room for growth just to get what its fair value is and then to continue on with its growth path. So I think it's undervalued in my opinion. And they say a fair value of $135. So let's go to the next slide. Morgan Stanley had a report out. I sent this report also to Mark, so he'll post it on the website tomorrow. They feel that their price target is 133, and it is an overweight situation. Next slide. So my quick and dirty DCF from the value line, I showed this last month. If you take the cash flow per share of $7.40 minus dividends, which there are none, minus capital spending per share of $1.35 equals $6.05. You multiply that by the cash flow per share from the Legends box, and that says by the cash flow alone of the company, the free cash flow, it could equal a value of $169.40. And if you look at the value line, next slide, the value line 2026 to 2028 projection is 165 to 250. So look at that. Morgan Stanley is saying that this is worth 135, Morningstar 133. I may have transposed that, but they think that going forward, this stock could go to 165 to 250. Let's just say it goes halfway in between at like 200 bucks. We'll make it round and easy. To go from $72 to 200 bucks, I think that's a cha-ching moment. So this is my personal opinion. Do your own evaluation and due diligence, but I think the stock is undervalued right now, and it could have a great capital appreciation potential. I hope you will consider it.
Okay, thanks, Kim. All right. Hugh, are you still with us, Hugh?
I am.
All right. Well, I know you couldn't find anything, or I'll let you explain that you didn't find
Well,
anything that really grabbed your attention tonight. What's
yeah,
your,
nothing that was really underpriced near a 52-week low or that had an outrageous dividend yield that also looked safe. I couldn't find anything. Maybe a little bit comforted by the fact that the market is close to an all-time high, at least based on the Dow, which I think is 1 or 2% off where it was at the start of last year, if I remember correctly. But yeah, I couldn't find a thing, and I just didn't want to buy something just for the sake of buying it.
okay? Well, with that, we talked a little bit about Ardelyx before the session, but how about an update on Immunogen? Any headline moments or things we should be watching? You picked that back in 2020 at $4 a share, and I believe it hit almost 18 today. So
Yeah, well, the technology that they use, and they were one of the pioneers of this thing called antibody drug conjugates. And at one point, there were probably just a handful of those programs in the pipeline, maybe a couple of dozen, not too many. Now there are hundreds. And this is a technology that uses the body's own antibodies. Right? These are molecules that target invaders, if you will. And they're very, very specific. So they're tuned to a specific antigen or a specific bad actor that's coming into the body. So, for example, you can develop antibodies for the coronavirus, as an example, and they will only target coronavirus and nothing else. So they use that targeting capability of an antibody to attach to it a very poisonous molecule, a molecule that if were released into the body at large, it would kill the patient. But they've developed the technology such that they can anchor it to the antibody and only have it released when it goes into the cell that the antibody detects as a bad guy. So if it's a cancer cell, for example, and there are things floating around the surface of that cell that uniquely identify it as a bad actor, a bad cancer cell, and you've attached a poison to it, it could be bleach, it could be anything. Once it gets in there and it's released, it wipes out and destroys that cell. And recently, a company called Seattle Genetics, and I think the acquisition of Seattle Genetics is now complete, SGEN, I think, was the ticker. That was a company that was started about the same time as Immunogen. It was based in Seattle, so on the west coast, as opposed to Immunogen is in the Boston, Cambridge area. They developed in parallel. I think it was sold for something like $300 or $400 a share, a huge number. It was bought for many billion, at least. I can't remember how that divvied up in terms of share price, but it had a very similar trajectory to Immunogen, where it languished for a very, very long time. It had loads of partnerships, but eventually it hit on the right combination of warhead and antibody, and it took off. And the great thing here is that the technology to bind the warhead, the poison, to the antibody, there are really two leaders in this area. One of them happens to be Immunogen, the other happens to be Seattle Genetics. And companies that use the technology obviously pay some kind of a licensing fee if those patents have not yet expired. But it really was a leader and still is a leader in this field. It's had really bad luck with its choice of what to bring forth in the clinic, and that's reflected in the stock price. You can see there from 1990 on. It's had a few signs of hope, but now it really seems to be making a bit of a comeback.
yeah, it's an interesting story. It'll be interesting to see what the analysts do with the combination company and how that unfolds. But what a nice bump! And as we said earlier,
Yeah.
in the green room, we'd like to see Ardelyx follow that
Yes.
a similar trajectory. All right. Well,
Yeah, Ardelyx needs a sugar daddy.
There you go. All right. So with that,
This is Herb.
yeah, go ahead,
I
Herb.
just want to mention that NVIDIA is up to 460 after market today.
Thank you, Herb. All right.
Toot my own. Sorry about that.
No, not a problem. So if you can stick around, Hugh, I think we'll get the poll out of the way. Perhaps the audience will have some other curiosities for us. Ken says
The poll is up, and all you have to do is use your mouse to vote. Let's put one of the four presentations. Let's put an extra $1,000 into the portfolio. If you don't like any of the choices, then choose none of the above. We have just under 80% voting right now. I'd like to get to 90% if we possibly could.
Even if you're with us for the first time, you're eligible to vote.
Doesn't cost anything, absolutely free. And the important thing is Mark doesn't know how you voted. So, you know, you.
I eventually see the results.
Yeah, that's all you see is the results, though, Mark. Okay.
If I misinterpret, Ann Manning will correct me, and she can probably tell me who voted for what.
Okay. I'm kind of counting to 10 backwards in my mind. We're up to 88% voting, and let's see if we can push it over 90. Not going to happen, so I'm going to close the poll. I'm going to share the results. And Kim, you have a resounding win this month with PayPal. So we'll put $2,000 into PayPal. We'll put 1,000 into Truist, Visa, and the Russell 2000 Index represented by IWM. I'm going to hide those results. And Mark, you want to continue?
Okay, just one tiny bit of housekeeping before we close down. Well, two tiny bits. Just a reminder that we do archive all of these sessions, all the roundtables, and including the bull sessions on YouTube under Manifest Investing. So you can go back and take a look. And there's some good sessions there. If you want a little bit more background on our obsession with the Little Rascals and Darla, including a few moments with Maria Bartiromo, these two presentations down the middle will accomplish that. And then also, we did a fairly decent series on the electric future last month, and that series of slides down there at the bottom, those three presentations were it's a pretty decent exploration of opportunities in the electric field. So interesting stuff. All right. As far as coming attractions, we do hold the bull sessions Tuesdays at 2. We will not have a session next week as I'm going to take a couple of days off and play some tennis, but we will be back 2 Tuesdays from today. And we have a few events coming up. I'm going to stop by an investment club in Elk Rapids. Really looking forward to that. It's an extremely well-managed club, and I can't wait to roll up our sleeves a little bit with that group up near Traverse City in Elk Rapids. And then I believe Cy and Ken will both be in Atlanta on the 19th for that session. So am I getting that right?
Absolutely. Looking forward to it.
And Cy, you got everything warmed up and ready to go down there?
Yes, sir. It's pretty warm.
Yeah, we're kind of used to that with our visits to Atlanta in August.
Mark, this is Herb.
Yes, Herb.
Yeah, that's at 9 o'clock on Tuesday morning, and it's made to be that Porta Value is a model club, and you build it in in-person event, and it could be online. Go to meetings.
Okay, so we'll put some details on how they can access that on the Manifest Investing website.
That'd be great.
Okay. Ken and I will both be in New Orleans on November 4th. We look forward to spending some time with that group down there. They've got a number of people near the top of the Groundhog leaderboard, so we look forward to that. And if you are out there and you have interest in inviting us to come and have some fun for a day or an evening, let us know. So with that, anything else you want to add, Ken?
We do have some questions, Mark, but I think we can wind the presentation up, and then if you could stick around and a couple of the guys can stick around for a little bit. We have 2 or 3 questions that we're getting some nice interest in, and I'd like to get them answered if we could.
Okay, so I'll go ahead and shut down the recording, and we can hang out and do some Q&A. Thanks, everybody.